Welcome to the SmartKeys podcast. Let's start by picturing your day-to-day reality for a second.
Right.
You are a modern professional, a leader navigating a market that is frankly becoming wildly commoditized.
Oh, completely.
You spend months, maybe even years, pouring capital into R&D to build this superior product,
Yeah.
finally launch it, and then, well, what happens? Your rivals just reverse engineer your specs and they match your features in like a single quarter.
Yeah, the differentiation window just keeps shrinking. What used to give a business maybe a 3 to 5 year competitive advantage, now that barely lasts a fiscal cycle before everyone else just catches up.
Right. And when the features converge across the board, the market just stops caring about the product itself and starts deciding purely on price.
Which is dangerous.
Exactly. And we all know the death spiral that follows, right? Destructive
Right.
discounting becomes like the only lever you have left to pull. And it is the single fastest way to completely obliterate your profit margins.
Yeah, it's a race to the bottom. But some manufacturers are pulling ahead.
Right. They are escaping that price war entirely. And they're doing it by making this massive structural pivot. They are stopping the sale of boxes and they're starting to sell outcomes.
Which fundamentally rewrites the rules of the entire industry. I mean,
Yeah.
instead of selling a physical machine and just, hoping the customer buys another one in 10 years, they're selling guaranteed uptime or output.
More performance.
Yeah, exactly.
Yeah.
And they bill for it on a recurring basis. For legacy manufacturers, this is increasingly a matter of absolute survival, not just some fleeting management buzzword.
And that brings us to the mission for today's deep dive. We are exploring a fascinating blueprint from 2026 by Felix Römer. It's titled Servitization Trend 2026, From Products to Recurring Revenue.
It's a great piece.
It really is. Today, we're going to break down how the smartest companies are stopping the one-off sale, securing 10 to 15 years of locked-in customer loyalty, and basically transforming their entire financial model into predictable, recurring cash flow.
Right. And the shift is known across the industry as servitization.
Servitization.
Yeah. But moving from a single transaction to a 15-year operational partnership that requires changing every single piece of a company's DNA,
Yeah.
from the engineering floor all the way up to the balance sheet.
Okay, let's unpack this, because there is a core economic principle driving this whole shift, and it's called the smiling curve.
Oh, I love this concept.
It's so illustrative, right? So to understand how this works, think about the restaurant industry for a second. If you are running a high-end restaurant, the raw ingredients,
Like the farming side.
exactly, the farm growing the potatoes or raising the cattle, that is fundamentally a low-margin, high-volume business. And the actual cooking on the line, like the physical assembly of the meal in the kitchen, is also surprisingly low margin.
Right.
So where does all the actual profit sit? It sits at the two extreme ends of the dining experience. On one end, before the meal is even cooked, you have the R&D and the branding.
The celebrity chef's name on the door.
Yes. The whole farm-to-table story you market to the public. And then on the other end, after the food is plated, you have the service experience. The white glove delivery, the sommelier pairing the wine, the ambiance.
And the translation of that to the industrial world is pretty seamless.
Totally.
I mean, in manufacturing, the physical assembly of a product,
Mhm.
literally screwing the metal widget together on the factory floor is exactly like cooking on the line. It earns the absolute least amount of profit.
Wow, yeah.
The real value, the high margins, they're concentrated at the R&D and design phase on the left side of the curve, and the after-sales maintenance, software, and service on the right side.
So if you plot that value distribution on a graph,
It literally dips in the middle and rises on the edges.
forming a smile.
Exactly, forming a smile.
So if you're listening to this and your company is just assembling and shipping physical boxes out the door, you are trapped at the very bottom of the smile. You're fighting for pennies while other people capture the dollars.
And the urgency here comes from the realization that, well, independent aftermarkets have been capturing those dollars for decades.
Right.
When a manufacturer sells a complex piece of machinery and then just walks away, a third-party maintenance company immediately steps in.
They just swoop right in.
They do.
Yeah.
And that independent company captures all the lucrative spare parts and service revenue for the next 10 years.
Which is huge.
Massive. So moving aggressively into outcome-based service models is how manufacturers win that aftermarket revenue back.
Yeah.
It is a defensive maneuver to protect margins.
Mm.
And the data point here is wild analysts project that outcome-based service revenue is going to jump from 25% of total industrial revenue to 41% within just 5 years.
41%. I mean, you don't see a 16% structural shift across global industries unless the old way of doing business is fundamentally broken.
Right.
But, okay, capturing the aftermarket revenue is a massive undertaking, right? Changing your entire revenue model overnight seems incredibly dangerous. So how are these massive industrial titans actually executing this transition without just bankrupting themselves in the process?
Well, they mitigate that danger by treating servitization as a ladder, a ladder of escalating risk and reward.
All right.
You don't jump straight to the deepest end of the pool. The framework essentially breaks down into 3 distinct models or tiers that companies graduate through.
Let's walk through those tiers because the mechanics here are really fascinating.
Sure. So tier 1 is product service integration. This is your entry level. The customer still buys the physical equipment from you outright.
So they still pay that large traditional purchase price up front?
Exactly. But alongside the equipment, they also buy a long-term support and maintenance contract that includes a basic performance guarantee.
Got it.
For the manufacturer, the risk profile is moderate here. The main danger is simply that your maintenance costs overrun your initial estimates, because the machine breaks down more frequently than your engineers predicted.
Okay, that makes sense as a starting point. You still get that big capital injection up front to cover your manufacturing costs, so your cash flow isn't entirely disrupted while you basically figure out how to be a service provider.
Right. But then moving up to tier 2 changes the financial dynamic entirely.
Okay.
This is product as a service, or pairs. Here, the customer no longer buys the asset at all.
Wait, they don't buy it?
Nope. They pay purely for the use of it. So maybe that's per hour of operation per unit processed, or even via a flat monthly subscription.
Oh, wow.
Yeah, and this shifts a tremendous amount of risk directly onto the vendor. That multi-million-dollar asset is sitting on your balance sheet, not the customer's. You're carrying the utilization risk.
So if a recession hits and they stop running the machine, your revenue just drops zero, but you still own the depreciating asset.
Exactly. It's high risk.
And then there's the holy grail, right? Tier 3.
Yeah, tier 3. The outcome-based model, also known as product service systems, or PSS.
Right, PSS. And this is where you aren't even selling hours of use anymore. You are selling a guaranteed, undeniable business result, like a specific percentage of factory uptime, or a set number of perfectly manufactured units, or even an exact metric ton of carbon emissions saved.
And that carries the absolute highest risk profile imaginable. I mean, if you fail to deliver that exact outcome, you are hit with severe performance penalties. The manufacturer is entirely absorbing the forecasting error.
But in exchange for taking on all of that operational anxiety, you lock in the deepest possible customer relationship and the absolute highest profit margins in the industry.
Or unmatched margins, yeah.
And the real-world titans executing this are proving just how lucrative it can be. Like the classic example in the article is Rolls-Royce.
Right, total care.
Yeah. They don't sell jet engines to airlines anymore. They sell thrust by the flying hour.
Yeah.
And then you have Xerox, right? They fundamentally changed the office environment by charging per page printed instead of selling the physical copier.
Signify is another great one.
Oh, right. They don't sell light bulbs to major airports anymore. They sell light as a service.
Exactly.
And Target, the commercial flooring company, they retain ownership of the flooring they install. They maintain it and then take the raw materials back at the end of its life to recycle it.
It is a complete paradigm shift from asset ownership to asset access.
Okay, but if I can challenge this for a second, though, put yourself in the shoes of, like, a mid-sized industrial manufacturer. If you retain ownership of all these massive, heavy assets, instead of selling them, let's say, a global fleet of earth-moving tractors, doesn't that completely destroy your balance sheet?
It sounds like it would, right?
Yeah, you would have billions in depreciating steel tied up, and your working capital would just be frozen.
And that is the exact trap legacy executives fear. But it misunderstands how the modern financial ecosystem operates. The smartest players aren't holding all that debt themselves.
Oh, they aren't.
No, they rely on an ecosystem play. Global financiers, leasing companies, and industrial insurers step in to underwrite the physical assets.
Oh.
Yeah, they absorb the capital risk, so the manufacturer's balance sheet remains light and agile.
So you're partnering with banks who actually want the steady, predictable yield. A bank doesn't want the volatility of the stock market. They want the guaranteed monthly return of a heavy machine operating reliably in the field.
Exactly.
Yeah.
And the ecosystem approach extends to the operational side as well. Because if you're a European manufacturer selling a guaranteed outcome in South America, you likely don't have the internal field technicians in every small region to guarantee, say, a 2-hour repair window.
Right, that would be impossible to staff.
Exactly. So instead of hiring thousands of employees, you partner with local, certified service networks who act as your boots on the ground. You orchestrate the outcome. You don't have to own every single piece of the delivery mechanism.
Okay, but capturing that aftermarket revenue and orchestrating an ecosystem is completely impossible if you're flying blind.
Right.
You cannot convince a global bank to underwrite a fleet of machines, and you certainly cannot guarantee an outcome to a customer if you don't actually know what the machine is doing in the field.
You can't manage a secret.
Exactly, which fundamentally shifts what these companies are engineering. They aren't just building motors anymore. They are building data transmitters.
Which brings us to the technology stack. Gathering that operational data is the absolute foundation of servitization.
Right, and the article notes that none of these companies jump straight to outcome contracts. They started by gathering data. So let's break down the specific software features required to make this service-led growth possible, because the terminology can get a bit dense.
You can't.
First, you need telemetry. We are talking about IoT, the Internet of Things. Tiny sensors attached to the physical product that stream temperature, vibration, and performance data back to headquarters.
And what the article points out is that the cost of these retrofit sensors has dropped to near zero.
Wow.
You can literally slap a gateway onto a 20-year-old legacy machine and bring it online without having to rip and replace the hardware.
But once those sensors are streaming the heartbeat of the machine, you're suddenly drowning in terabytes of raw data.
Which is where analytics and AI step in, to actually make sense of the noise. The AI analyzes historical patterns and turns that raw telemetry into predictive action.
So it doesn't just tell you a machine broke.
Right. It tells you which specific asset is going to fail next Tuesday. And crucially, it tells you exactly which spare part the field technician needs to put in their van before they drive out to the site.
That's incredible. And then you have digital twins. This is a complete virtual simulation of the customer's physical environment. So before you push a software update or change a maintenance schedule, you test it on the digital twin to ensure it won't cause a bottleneck.
It is the ultimate insurance policy for avoiding those massive SLA penalties.
The service level agreement finds you pay when you break your promise to the customer.
Exactly. And wrapping all this together is SLM, Service Lifecycle Management. This links the real-time field data back to your ERP and CRM.
Your core financial plumbing and customer databases.
Right, so your finance team knows the exact true cost to serve for every single asset in the world.
Yeah.
But the source material issues a massive warning here, though.
Oh.
Yeah. All of that incredibly sophisticated technology, the predictive AI, the sensors, the digital twins, that is almost never where these transformations stumble. The true bottleneck where most outcome-based pilots absolutely stall out is the billing system.
Wait, generating the invoice is the hardest part?
It is exponentially more complicated than a standard invoice. We are talking about highly dynamic usage-based invoicing coupled with incredibly complex revenue recognition laws.
Oh, right.
Yeah, if a customer's machine runs at 90% efficiency for 3 days, drops to 70% for a week due to operator error, and then surges to 100%, how does your system dynamically adjust the monthly contract and recognize that revenue legally?
Man, that's a headache.
Legacy enterprise billing systems were built to sell a product once and forget about it. If you do not validate your dynamic billing architecture in the very first stages, your entire service transformation will collapse under its own administrative weight.
Here's where it gets really interesting, though, regarding the technology. For years, the ultimate playbook for this transition was supposedly building a massive proprietary software platform.
Right.
Think of General Electric a decade ago. GE's Predix platform was the star of every single PowerPoint presentation about the future of industrial IoT. They were going to become the ultimate digital-first software company that just happened to make turbines.
Yeah, that was the pitch.
But look at the reality of what happened. GE ultimately split up. And just recently, in March 2026, GE Vernova sold off its Prophecy manufacturing software business to a private equity firm for $600 million.
Right.
The entire platform-first strategy was essentially a mirage. To use an analogy, it's like a package delivery company deciding they need to build their own delivery trucks from scratch down to the engine instead of just buying a fleet and focusing on delivering the packages on time.
What's fascinating here is that the failure of the platform-first playbook doesn't mean industrial software is useless. It means that becoming a software vendor was a massive distraction from the actual value proposition.
The delivery company shouldn't be in the truck building business.
Precisely. The real strategy, your actual competitive moat, is your massive installed base of physical machines. It is your long-term relationships with customers, and most importantly, it is your proprietary ability to price risk based on decades of historical maintenance data.
Right.
Software is merely the delivery mechanism to execute that strategy. When companies try to pivot into becoming the next Amazon Web Services, they lose their core focus. When they use off-the-shelf software to make their service contracts flawless, they win the market.
And if you already have that data layer in place, if you are actively monitoring your equipment and understanding your lifecycle costs, you are accidentally perfectly positioned for the massive legal and regulatory changes hitting the market right now in 2026.
The regulatory landscape is shifting incredibly aggressively, and it is acting as a massive accelerator for the servitization trend, particularly in the European Union.
Yeah, we're seeing two major forces colliding here, right?
We are. First, the Right to Repair Directive, which becomes mandatory in July 2026. Second, the Eco-Design Digital Product Passport, which is rolling out right now, starting with industrial batteries and expanding to almost all physical goods by 2030.
And usually when business leaders hear the phrase EU directive, the immediate reaction is panic about compliance costs and bureaucratic red tape.
Oh, sure. But treating this as merely a compliance exercise is a massive strategic error. Smart businesses are weaponizing these regulations as a strategic asset.
How so?
The EU is essentially forcing manufacturers to create a digital birth certificate for their products. You have to document exactly what minerals are in a battery, track every time it was charged, log every repair it underwent, and guarantee spare part availability for a decade.
Wow.
What does that sound like? It is the exact rigorous data foundation you need to accurately price an outcome-based service contract.
That's brilliant. The government is literally forcing you to build the infrastructure for your most profitable future business model.
Exactly.
If you have to build the database to avoid fines anyway, you might as well monetize it by selling outcomes.
Right.
And we're seeing companies not just building this capability internally, but actively buying their way into the ecosystem. Look at Xerox's $1.5 billion acquisition of Lexmark in 2025.
Yeah, perfect example.
Xerox wasn't spending $1.5 billion because they desperately needed more printer hardware designs. They were buying Lexmark's massive installed base of active clients and their global service delivery scale. They bought the ecosystem
Because the operational capability to deliver a service at a global scale and the technicians required to maintain it are becoming far more valuable than the capability to manufacture the hardware itself.
Let me push back on this from the perspective of the actual customer, though.
Okay, sure.
We're sitting here talking about how wonderful this is for the manufacturer's predictable revenue and profit margins. But if I am a B2B buyer, say a factory manager, I have to be honest, I am completely exhausted by subscriptions.
Oh, we all are.
Every piece of software, every tool, every vendor wants a monthly fee. Is a procurement team really going to accept another ongoing subscription for their conveyor belts or their air compressors?
Subscription fatigue is a very real, measurable headwind. B2B procurement teams are actively auditing their operations and slashing recurring costs wherever possible. If a manufacturer's version of servitization is simply taking the upfront purchase price of a machine, dividing it by 12, and calling it a monthly subscription.
The market will reject it instantly.
Instantly.
Because you aren't adding value, you're just adding a new, annoying line item to their operating budget.
Precisely. To succeed and cut through that fatigue, a service offer must actively remove a painful cost that the customer is currently carrying.
Give me an example.
Well, think about the daily reality of that factory manager. Right now, they have to employ a dedicated team of fixed-cost maintenance engineers. They have to hold hundreds of thousands of dollars in spare parts inventory just gathering dust in a warehouse. And they suffer massive financial losses every time there is unscheduled downtime.
It is a massive operational burden.
It is. So when a manufacturer offers a true outcome-based contract, they are stepping in and saying, liquidate your spare parts inventory. Reassign your external maintenance contractors. Let us completely absorb the financial cost of downtime. You are converting their bloated, unpredictable fixed costs into a sleek, predictable variable cost that scales with their actual production. You aren't adding a burden to their ledger, you are alleviating one.
That makes total sense. So what does this all mean for you, the listener? We've covered the macroeconomics of the smiling curve, the technology stack, the shifting regulations. But if you are a leader in a business today, how do you actually apply this knowledge?
The ultimate takeaway is recognizing that selling outcomes is the strongest defensive moat a business can build today. A rival competitor can buy your product, reverse engineer your specs, and spin up a cheaper factory in a few months. But they cannot reverse engineer 10 years of proprietary machine performance data. And they cannot quickly replicate a perfectly calibrated risk pricing model. That takes a decade to build. Implementing this transforms a company's highly vulnerable one-off sales into incredibly resilient, predictable revenue.
But getting to that resilient revenue means fighting a brutal internal culture clash. The article makes this abundantly clear. If you have a traditional sales team, their entire compensation structure, their bonuses, their livelihoods, is likely built around closing massive, multi-million-dollar unit sales by the end of the quarter.
Oh, yeah.
If leadership suddenly tells that seasoned salesperson to stop selling units and instead sell a 10-year retention contract that only trickles in a few $1,000s a month, that salesperson is going to actively sabotage the initiative.
It completely shatters the traditional incentives. Sales and service can no longer operate as separate silos, where sales closes a deal, collects a commission, and throws the customer over the fence for the service team to deal with.
Right.
They have to become one unified commercial motion long before the ink on the contract is even dry.
Which is why the source text provides a very pragmatic, psychological blueprint for the first 90 days. You do not try to overhaul your entire enterprise culture on day one. You start incredibly narrow to prove the concept.
The blueprint is highly specific. Days 1 to 30. You pick exactly one asset. Do not try to boil the ocean. You select a single product line that already has a large installed base in the field, where unexpected downtime is highly painful and expensive for the customer, and where it is relatively easy to retrofit those IoT connectivity sensors.
Then, days 31 to 60, you establish the baseline. Before you ever speak to a customer about outcomes, you absolutely must measure your current failure rates and understand your true cost to serve.
Crucial step.
Yeah, if you try to guess how much it costs to maintain that machine over a year, you will almost certainly underprice the contract and bleed money. You have to know your internal math first.
Finally, days 61 to 90. You sell exactly one contract. You find a friendly, forward-thinking customer who trusts you, and you offer them a basic monitored maintenance agreement. You don't offer a wild 100% uptime guarantee right out of the gate, just a modest availability commitment.
Keep it simple.
Exactly. And crucially, as we discussed with the billing bottleneck, you force that single contract through your actual enterprise billing systems. Do not manage it on an ad hoc Excel spreadsheet. You have to prove the internal plumbing actually works.
If we connect this to the bigger picture, the golden rule of servitization is sequence. Modernize your data layer first, pilot one highly specific segment, prove the unit economics in reality, and only then do you attempt to scale those standards across the rest of the enterprise.
It leaves us with a fascinating, almost philosophical question to ponder as this trend accelerates.
What's that?
Well, if every physical machine, every tool, and every heavy asset in the global supply chain eventually becomes a service, we are entering a world where businesses essentially own nothing but the outcomes they produce. The physical assets themselves just become transient conduits for data and performance. So how will that fundamental shift in ownership change the way we value companies in the future? If a manufacturer owns no physical factories and a customer owns no physical machines, where does the true equity of the global economy actually lie?
That is a wild thought to leave on. The true value isn't in the raw metal anymore, it's entirely in the guarantee.
Exactly.
Thank you so much for joining us and tuning in to the SmartKeys podcast. If you want to dive deeper into how this shift is reshaping industries and explore the full 90-day blueprint, you absolutely need to read Felix Römer's full article. We have dropped a link right in the show notes for you to explore. Make sure you hit subscribe so you don't miss our next deep dive, and we will catch you next time.